by various people. I've been asked to talk about equity market returns. As an introduction, Castlestone Management's actually been dealing in South Africa for many years. We don't have, or we are not FSB regulated in terms of particular funds. So if we do, we operate on a platform which is approved for investments here. Or alternatively, we still continue to talk to a lot of clients who had older policies that were sold here, like a Generali or a Royal Scandia, and the money still needs to be moved around inside those particular products. But it's always done through a particular product. We're not discussing an actual fund, we're discussing more an outlook. And I thought it was interesting, the introduction you were all given to say that the people speaking to you are experts. The others might be, but I can assure you from an investment perspective, none of us are proven to know anything at all. And I think that's what this presentation is trying to show you. I'm not necessarily, therefore, giving you a solution necessarily, but what I am showing you is that no fund managers, in my belief, are any good at their jobs, to be quite honest. So this is an outlook with regard to equity markets. And even in The Economist this week, it talks about real pension returns for the last 10, 12, 14 years. Basically, it says in Spain, the average person lost 2% in real terms per year for the last 14 years. And it says the average person in the United Kingdom lost 1%. That shows you that if anybody really knew what they were doing from an investment management perspective, those returns would be vastly different. So we're all incompetent, and we all don't know what we're talking about. And I'll show that to you. So the first thing we did here is what are equity markets in terms of returns? And what we're saying is those returns, I think, are uncertain. If they weren't, then I would have been able to tell you with confidence two things. One, the direction of the South African rand, which none of us have got any idea about. And second of all, that we would have gone through a major bull market in the last 5 years. None of us knew that. I was presenting to you 5 years ago, early 2009, and said to you we're about to enter a major equity bull market. You would have all thought I was sceptical or laughed, or been sceptical or laughed. The reason for it is that we just don't know. And there are very few people that make any excess returns in the world, and the only way that they do make excess returns is through leverage, and I think I'll show you leverage is a pretty bad thing overall. So excess returns only come from taking on significantly larger amounts of risk. So in this slide, I'm really just saying I think it's all a gamble. This one's just to give a quick overview, so we'll spend about 10 minutes on an outlook, a little bit with regard to a fund which I won't actually be discussing in detail here, and then just some conclusions or questions if you've got them at the end. I thought this was quite interesting in terms of the slide. Well, what it basically says in terms of the blue line is what economists' forecasts were going back to 1965, and then it shows you what the actual returns were. In other words, the economists have got no idea at all either. Now, you all probably know that we joke about it, but all economic forecasts in terms of stocks by a stockbroker or a fund manager are based upon economics. You're not going to say a company's revenue line is growing by 10% per annum if the economy is contracting by 6%. So if these people are wrong, all the stock analysts have to be wrong. There's no other way around it. So it goes to the same point, none of us really know what's going on. If we therefore look at the performance into these are analyst forecasts versus the actual outcome going back to 2004. Yeah, well, they had no idea at all. I mean, in 2007/8, they were all talking about the earnings of companies rising, and they fell quite dramatically. Instead of rising 30% off their mean, they were down 20%. So in other words, analysts have no idea at all either, because nobody has any real idea. So when sorry, I'll just change it. I'll tell you what to speak. I'll speak loud. These are hedge fund returns, and hedge funds were sold. Even my company did the same thing. We backed the concept that hedge funds were really good things, and they weren't really. As a mix, they had far too high fees, and when you put a platform fee around it and a financial advisor fee around it, the fees basically killed the returns. So these are the average annualised hedge fund returns over 1, 2 and 3 years. Now you reckon they would have made a lot of money in the bull market, going up in a straight line, but they actually underperformed the equity markets. Hedge funds aren't the answer either. There's a bigger problem with hedge funds is they're not transparent, they're not liquid. So that's another issue to come to. But I'm just trying to say here, even the media forecasts that hedge fund managers are meant to be very good at their jobs, and they're pretty incompetent at it too. The excess returns you get from a hedge fund tend to come purely from leverage. When we look at the returns on, this is a comparison of fund managers versus an index from 1998 to 2003, 275 successful funds, and 97% of them underperformed. 97%. There's a reason that 97% of them underperform, and it's pretty easy. If they're working for a bank, let's pick on Barclays for a minute. They work for Barclays and they're running a fund for Barclays and they want to outperform. They want to outperform, it means they have to take on more risk. Risk is equal to reward. They want to get a bit more return, you have to get a bit more risk. So let's say in year one they get it right. They get patted on the head, Barclays gives them a little bit more of a bonus and everybody's happy. Okay, next year the bloke takes on risk and being human, he gets it wrong. Well, Barclays doesn't like him, Barclays fires him, he goes home, his wife divorces him, and the regulator comes and shoots down his neck because he differentiated from his benchmark. Take away fees, they're never going to outperform. They're never going to outperform. So there's a structural human reason why. Forget intelligence or economic forecast, they won't differ because they don't want to get divorced, they don't want to get fired. So when we look at funds today, one of the things we learned over a period of time, you've all seen it in your own capacities in terms of investing in funds, is something that I think all funds need to have. Obviously platforms require this as well today, but it's just a general set of principles. First of all, I think all funds have to be liquid. And what I mean by liquid is the fund has to be daily. I guess you can go weekly trading, daily or weekly. It doesn't improve your returns, it just improves your comfort that you can actually get the money out. The second or the third point we've written in there is exchange trading. We mean that the instruments that the fund is owning are exchange trading. They're listed and they're liquid. And there's no point in having a daily traded fund, like a property fund, with daily trading, it takes you 6 months to sell a property. You all know what happens with regard to the funds at that point in time. They suspend, they remain in suspension, they go down NAV, and all sorts of problems happen, even if there's nothing wrong with the asset. So you need the fund to be liquid and you need the underlying instruments to be liquid. The other one is transparency. I think we've all had enough problems buying something we don't know actually what we're buying. So I think you need complete transparency. If you don't get complete transparency, the people probably aren't being honest or open with you. And then lastly, no leverage. The reason we added no leverage, not only is it restricted by platforms today, but leverage distorts returns. It distorts it on the up and it distorts it on the down. The problem is, most people take on more leverage when they're confident the markets are going up, which happens to be the inflection point is when they go down. And of course they don't take on very much leverage when the market's already down because they're scared, and that also happens to be an inflection point when they go back up. So leverage distorts returns. It also makes it a lot harder for you to explain anything to your clients because you get distorted returns, particularly with variable leverage. So let's just take a look at equity markets going back to 2000 to where we are today. I think the average equity market has now given you a 1%, maybe 2%, if I'm taking on board, a 2% nominal per annum return over this period of time. In other words, you would have been better off leaving your money in the bank. My assumption is, just because of the nature of where we are in the world, and I'll show that to you with regard to levels of debt and interest rates and where we're forced to put money, is equities are probably the only real choice of investment we have, although I just don't think they're going to give you very good returns. I just think they're going to go up and down, up and down, up and down, like this is. Because this has basically been doing it. The reason for it is that back in the 80s and back in the 90s, you got very good equity market returns, 12% per annum type returns. Now we're eating it out over the next 20 years, so from 2000 to 2020 out here, where you'll get no real return. So on the average, you'll get the long-term average return of equity 6%. So I know that's a bit disappointing because there are two statements I'm making. One, this is the only asset class I think you can invest in. And two, you may get shit returns from it. Okay? And I'll show that to you in a bit more detail. Here is the S&P 500, 20 years, 2000 again. This is the bull market we've just been in. This is astronomical. Astronomical. And the reason it's astronomical is because you've got nowhere else to put your money. You can't put it in any more property funds. You're not going to buy any shit hedge funds. You're not going to leave it at the bank. And you're not going to buy all those variable debt, other things which we don't really understand or can explain to anybody. So you're left buying equities. You, the rest of the world. So you've bought equities and they've gone up in a straight line. I just can't quite imagine this is going to keep going.
I'm not saying it's going to fall, because if it goes down, anybody who's got money in the bank is going to buy equities again, and it'll go back up. So I'm not saying it's going to go down. I just find this an astronomical move. But we're forced into it. Why are we forced into it? Principally because we're in a distorted world. We're in a distorted world of incredibly low artificial interest rates. So here's a statement, even though economics, I say economists don't have any forecasts, and we don't know what they're doing, but I think in this case we can make an assumption it's unlikely rates are going to go much lower. Now, if they're not going to go much lower, they're more than likely to go up. But they're also not going to go up by very much, because we have a huge amount of debt in the world. Currencies floated back in came off the gold standard in 1971. They floated from the 80s to the early 90s. We borrowed more and more money. We became a fair currency economy in the world. We trade with each other. The debt levels in the world are enormous. What this means is you only need to increase interest rates by a little bit to have a very sensitive effect on the economy. And you would know that here. You lift interest rates by 1.5% or 1%, you know the effect it would have on the average person on their mortgage, etc., particularly if you've got variable mortgages. So what it means to me is interest rates are unlikely to rise very much. They're also unlikely to go down very much. Personally, that means you should borrow as much money as you can, because it's not a bad thing to borrow the money as long as you can afford to pay and buy a house. That's not really an investment, that's living quality. So I think it's a good thing, but it's a false thing. It's a good thing for us to buy a house with. It's a false thing because this isn't real. What it does do though, is it makes higher yielding equities, which is where I have the majority of my own personal money, very interesting. And I'll come to that. If you can buy a big, boring, dull stock, maybe your Sasol, I guess, here, or Trustworth, not quite exactly what I mean. There's a big, boring, dull company that gives you a 5% yield, that's much better than being in a bank. So what we'd say here is interest rates are likely to remain low for a very long period of time. If they go up, I'm saying a little bit, you're not going to get much of a return. Same with European interest rates. Of course, Europe, if the world is fantastic and wonderful, hence why equities have gone up, then in Europe would be contemplating lifting interest rates. Well, recently, as you know, they lowered interest rates. Don't quite know by lowering them by 5 basis points is going to have any effect, but it says to you the world's not a really safe place, otherwise rates will be higher. So again, rates are very low. Amount of debt in the world, they are going to therefore remain low. What we've got is a huge dislocation that's occurring in the world. That is that the bond market is rallying because people are trying to be safe with their market, with their money. This is the interest rate on the 10-year bond in the US. I think it's now down about that level there. And equity markets are up there. Well, normally they're sort of consistent with each other. The reason for it is because you've got nowhere else to put your money, you're buying this. And because the other people are so scared not to buy this, they're buying this. So I think if this falls a little bit, they'll sell this and buy this. That's why they'll go up and down and up and down and up and down. It makes, by the way, a terrible outlook for your clients' investment portfolios, because you don't get any real returns anywhere. If you're only getting 2% per annum plus over 10 years in the US bond market, it's a pretty poor return. So, what are your choices, or our choices, I guess, for investments? One of those is property. Not a bad investment, I agree. Just don't buy it in a fund. The problem with a property fund, as you know, with someone like the student accommodation funds, is the student accommodation is fantastic stuff. Pays a yield, students are in there wrecking it every week, fantastic. Okay? But you can't stick a daily or weekly trading fund on a thing that will take you months and months to sell. Because when you want your money back, and too many of you want your money back, it's like a bank loan. It runs out of money, because it has to be fully invested in property. So that property ends up with a problem of liquidity, is really what lies behind it. It's a proportion of a portfolio, but it does have a major liquidity problem. Then you get locked up in it for months on end and you end up with clients who are autistic. Okay? The next one is bonds. Well, we just went through bonds. 2.3% per annum return over 10 years where inflation's at least at that level. Okay, they say it's not. It seems to cost me a lot more every year. This isn't a very good investment. Okay? Cash rates. Well, you don't get any real return here at all. So that's not very good. Commodities. Not bad, but I think there's a big difference between them. If you look at gold, and one of the things that my company did was started a gold fund many, many years ago. If you look at gold, it's a good hedge against the devaluation of money. Miners want higher salaries, which they probably deserve. They get higher, the cost of more to live, your electricity prices keep going up. they want more, cost the mining company more, therefore it costs them more to produce the commodity, and the prices have to rise. The case of gold though, if you've got a cell phone, a bar of gold that big costs you nothing to store. It's pretty easy. Just put it in the safe somewhere, 14 basis points a year. This is about 500, 600 barrels of oil, which is this room on a couple of levels. It costs you a lot to store. So the problem with oil is not that it's necessarily a bad commodity, it's just that it costs you about 60% per annum to store. So if you hold a fund over 10 years, you're spending, call it, be conservative, 40%, if not 60% of your costs are going in storage. Not a very good return. So in the commodity space, I would say gold, precious metals, yes. The other broader commodities, no. Agriculture, conceptually very interesting, very difficult to explain to your clients. Therefore, what are you left with? You're only left with equities. And this is the same conclusion I came to when I had to assess what to do with my money and what I actually have to do with it to try and make a return. And I'll show you the type of equities. This is how we came to a conclusion on the type of equities you should buy. And there are numbers of funds that do this, so it's a broad concept. The first one is Societe Generale put together this thing called a quality index. They basically said stocks with high dividend yields, solid balance sheets do very well. That's their index. They, being a fund manager, of course, lied to us all because they stripped out all the banks inside their index. Of course, had they had banks back in 2008, as you know, many of them went almost broke, some of them did go broke, so the index wouldn't look as good. But I think the banks are in a better place as a whole. I know you've got one that was a bit wobbly the other day, and there are a few in the rest of Europe that are a bit wobbly. But basically, the concept is high-yielding, boring stocks do pretty well. So, what type of boring stocks? And I'll show those to you in a second. But there's another thing that we looked at, is the S&P has a buy-right index. What that basically is you have an index, you sell a call option against it, a covered call option. It's a very simple thing, it's not complicated, it's very simple. You sell a call option against it and you get some additional income from it. It's called premium income. And if you keep doing it over a period of time, you outperform your index. But you can outperform it by a fair margin. This is 40, this is about 70, you've got nearly a 30% better return from it. So it's a buy right. It's a very simple concept, but it's owning a stock and selling a call option against it. It's the same as stock, you can do it with an index. So we combined that together and we said, let's look at some stocks in the world that might fit this profile. And so there's funds like the BlackRock high yield fund, etc., that are out there that do similar things. We combine basically the idea of a high yield and a premium income to get our return because we've got no idea where the stocks are actually going to go. I just think the stocks will probably be about the same price in 8 or 10 years' time. So what we said is let's buy stocks that are semi-monopolistic, in other words, they're big and dominant, and got high dividend yields. Now, by semi-monopolistic, I don't mean Apple Computer or Samsung. They are semi-monopolistic in their own way, but they're consumer electronic companies. The most boring company I can think of, to give an example, of is Sydney Airport. Okay? The reason I mention it is, I just was in Sydney yesterday, it is a boring, dull airport. It's not very big, and there's only one way to get to Sydney because you don't want to go by a boat. And if you want to go anywhere in Australia, I can't imagine you want to go anywhere else but Sydney because the rest of it is not much there. So if that's the case, what's so interesting about Sydney Airport? It gives you a 5% dividend yield. 5%. That's because it makes all this money, it's got nothing to do with it. So it gives it back to us. Now there's lots of stocks that do this. E.ON, EDF, which is a utility company, American Electric, BA Systems, Transurban, they own all these roads in Sydney. Imperial Tobacco, it's on a nearly 5% dividend yield. So the average dividend yield of all of these type of stocks is just under 5%. So that's a pretty good return. I own the stocks, I don't know where they're going, assuming they'll be about the same price in, I don't know how many years, 5, 8, 10 years, then at least I'm getting 5% per annum. That's a lot better than just owning a fund which is going to underperform the index. What we then do, and others do it too, is we sell a call option against the stocks we own, and we get another 9% in premium income. So what I'm really saying is, the way we think you make money in equities, first of all is to buy high yielding stocks. lots of funds that do. Let's take a look at high yielding stocks. And there's a logic behind it. If the world goes down and everybody gets a bit worried, the stock market comes down, the stocks that are likely to go down less are the big, boring, dull ones with high dividend yields. Yes? Because the ones that will go down are those terrible shit companies like Facebook and all the terribly moral destroying companies. You should read that woman's book of the COO. She says she empowers women and yet Facebook takes it all away. So it's a terrible, terribly bad company. But when the world goes up, then the stocks would go up a lot. Yeah, because they do better. But over time, these aren't real companies. Whereas a Sydney Airport and a Sasol, they're real companies providing real things on an ongoing basis. So we like dividend yields. The other one that we like is the premium income if you can get it, which is a bit specialist, but it is a concept that exists in many other funds as well. It's the premium income. The reason we like these two is because we've got no idea where this is going. You know, if you'd asked me last week, do equities look like they're overvalued and going down? Yes, they do. The Fed minutes come out, they all go up 3% like they did last night. Everybody thinks it's all right again. None of us really have any idea about this. So if I put my money, which I do, I put 60% of my net worth in this type of structure of getting returns from dividend yields and premium income, that's where your return will come from, not from equities going up or equities going down. And no fund manager can present you and say, I know that my fund manager's better and I run a better fund and I'm better than anybody else. Because if you take a look at their funds, they all went down in 2008. All of them. So anything he's saying is crap. Because if he was any good, it wouldn't have gone down in 2008. It just wouldn't have gone down. So they're not telling you the truth because they don't really know what's going on, because their economists don't know what's going on. So to us, I think the better thing to do is to focus upon boring stocks. So we gave one here, Sydney Airport, there was its share price, and that's its yield. That's pretty good. I like the 5%. At least I'm getting 5%. Covers a few costs. So if the index goes up and down and up and down, and I only get, after all my costs, the index return, at least I'm the same as everybody else. Because we know that buying a platform is expensive. We know you have to be paid. All those fees come into place. Even if it eats away some of that 5%, the client at least has a chance of getting a return above an index. Because if he doesn't, he's going to get a return which is below the index, less the fees. So one's at least 2% above, one's at least 3 or 4% below per year. Multiply it out by 10 years, and you get a vastly different perspective on what they're doing to a client's portfolio. So high yielding, boring, dull stocks are sort of what we came to the conclusion on, is the only thing we can look at. I'll skip those. So here are just the conclusions on it. 1, funds need to be liquid, transparent, exchange traded and unleveraged. That makes your life easy. Okay, it makes my life easy if I have those funds too, as long as we can make some money in doing it. But that is much easier than anything else that's out there. Low interest rates, likely to stay. As we can judge, they're unlikely to go down very much. They might go to 0, but they're almost there. So they're only likely to go up a little bit. We've got so much debt, so it's unlikely they're going to go up very much. There is a huge disparity between bond yields and equity returns at the moment, but I don't think that's going to change. And if the stock market fell 20% tomorrow or over the next 2 months, then I think you'll find anybody who's got some money in the bank will put it into equities. I will too. Why not? Stocks, therefore, to perhaps look at, semi-monopolistic, price inelastic. And price inelastic meaning if you put the price of a good up, you can still buy it. I guess you could say that's a cell phone company to a degree. Your electricity company seems to do it pretty well here. We all seem to get stuck with higher electricity prices every time one come here. Strong balance sheets are good, and therefore a higher dividend yield. And then the premium income is just something that comes on top of that in terms of better returns. So that was 25 minutes. If you've got any questions, please be happy to ask me, and then you can have your next speak. Any questions?